Good morning, good evening, good afternoon to everybody. Right now, I'm going to take you through what is the market outlook and how Tikona Capital is looking at the markets as of now. Just to give a brief introduction, Tikona Capital is a SEBI registered investment advisory as well as a research analyst. We have small cases listed as well as we help our customers or rather we help them to build portfolios which can help them navigate the markets quite well. So let's discuss how we are looking at markets. So, a standard disclosure, we are a SEBI registered investment advisor, as I mentioned. Everything that we say in this presentation is largely for training purpose and our views on the markets. You should always consult an investment advisor before taking any of the decisions. Similarly, registration granted by SEBI does not, or SEBI or BSL, does not guarantee performance of intermediary or provide any assurance of returns to the investors. And before you make any investments or markets, those securities are subject to market risk, and you have to read all the related documents carefully before investing. And last but not least, consult your investment advisor before taking an action. So coming to our views of the market, yes, if you look at, has been quite good as far as India is concerned. But incrementally, the global markets which are doing well has been softened as far as India is concerned. So global scenario, interest rates definitely are peaking out primarily because of peaking out of inflation. US has embraced an era of higher for longer inflation rate, as we discussed, while peaked out, but at the same time depends on the geopolitical situation, which is where the crude is extremely related to it. Domestic scenario. India stands out, which is balancing the interest rates as well as the long-term dynamics remain quite strong. Near-term risks definitely are largely crude, as we discussed. Geopolitical, again, both of them are quite related, but at the same time, global interest rates have been shooting up quite high, which is what may impact businesses in the near term. And of course, election 2024 is what one has to look at. So, second half definitely is likely to be moderation of the overall economic activity as well as markets possibly, which is what is going to provide us an opportunity to build a long-term portfolio. As I mentioned, yes, in the last 1 year, DAX or maybe European markets as well as Nasdaq has done quite well. In the last 6 months, Nifty as well as Nikkei or Japanese market has have done quite well, and I'm sure all of you are seeing that mid cap, small cap rally, and on top of it, the SME IPO rally has been quite stupendous, and which is what is driving gains with many of the investors. Nonetheless, last 6 months, especially 2023, has been quite volatile as far as developed markets are concerned. If you look at interest rates, they have peaked out in India, stabilizing globally, especially given the fact that inflation has also peaked out as we discussed earlier. To some extent, we discussed this where higher for longer, US is going for higher for longer. ECB is sticking to high interest rates despite recession signals in their largest economy. Countries like Germany are seeing slowdown or drop in the industrial production. Japan is actually seeing good growth, and we are seeing a 30-year high as far as the markets are concerned. And China, nonetheless, is kind of struggling with their real estate sector. So, if you look at the interest rates in US, it has been fastest pace ever in the US history, and which is what most of the businesses could get surprised, primarily because of the pace that we have seen in the US interest rate scenario per se, right? So again, Fed has been quite hawkish, primarily because of inflation being quite sticky, not coming down. It rather started rising to 3.7% after kind of going near 3%, and which is what has led to the hawkish stance. Eurozone inflation again is really being stubbornly high. while it has shown some moderation, but it is on a sticky note. Global PMIs have come down, but it is largely because of stocking, which is likely to be kind of, and is it coming to an end, is what we have to see as far as European countries are concerned. Nikkei, as we said, that it is kind of at 30-year high, primarily because of inflation being controlled out there, as well as the interest rate. If you look at the Japanese central bank has been controlling interest rate quite well. China GDP largely getting impacted by real estate sectors and issues in real estate sector, and lower interest rates is what is, or maybe the lower interest rate scenario which they are looking at is help is to support the economy as such. Now coming to the domestic economy, yes, domestic economy is maintaining its momentum. I mean, we are not seeing kind of slowdown that the global markets or global economies are seeing. Momentum is quite on track. High frequency indicators are suggesting even second quarter to be shaping well. While monsoon was relatively a bit tepid, nonetheless we should be able to handle things well. Um, Food items or core food inflation is looking a bit on uptick, primarily because of slower monsoon. Private sector data is quite healthy. If you look at advanced tax payment, they continue to grow in double digit. So we can fairly see that corporates are investing. So we can fairly assume that 24 growth will be quite robust, somewhere around 6 or 6.5. Yes, inflation is within the RBI's target range of 2 to 6%. While it's shot up, I mean, of course, RBI is playing up as far as keeping the interest rates within the well controlled per se. And let's hope that global interest rates do not start impacting India's interest rate scenario. And of course, we have all seen that with inclusion to JP Morgan index, we could see a healthy inflow of money towards Indian bonds. So, I mean, this is an affirmation that India's growth is on track. IMF has raised India GDP growth from 6.1% to almost 6.3%. And that's the thing. And then compared to others, possibly Eurozone and China has been kind of downgraded by IMF. Domestic investors flows continue. Right, FII is saying we are seeing a very healthy inflows by the domestic investors themselves. SIP continues to grow. I mean, it is very healthy at 16,000 crores. I'm sure even you guys would have seen market gurus talking about a good support to the market, especially given the fact that mutual funds would be sitting on 5% cash, which itself is upwards of 1 lakh crores. Similarly, SIP book further adds to that. And yes, local pension funds or large institutions continue to see flows, which is what is likely to help the markets in any kind of correction. So, well, I mean, we saw most of the things on the bullish side, but at the same time, one needs to be at least on the watch, given the fact that our exports are declining, but at the same time, bank credit is quite healthy. So, while this affirms the domestic growth being strong, but at the same time, and slowing global economy is what is impacting the exports. So, we need to be watchful. If you look at the infra activity, which is what has been supportive of GDP growth, while consumption continues to be kind of tepid, unlike in the past where consumption as well as infrastructure has grown at the similar rate, right? So we need to be watchful of these things. In terms of medium term outlook, yes, our economy continues to be quite strong. From a $3.5 trillion, we are expected to reach around $7.3 trillion by 2030. If you look at what the Ministry of Economic Affairs says, we are likely to exceed the Japanese GDP by 2030. We already exceeded UK and France in 2022. This is largely supported by growth in middle class, the consumption, as well as the investment driven demand in the economy. And of course, FDI continues to be strong, primarily because nobody wants to miss out on the India story. And the large consumption market, as well as the industrial market, especially supported by PLI schemes is likely to attract fantastic investments into our country. So these drivers in the medium term are likely to make India fastest growing economies over the next decade. Now that's not something, and as I said that yes, our economy is one of the fastest growing, much higher than China, emerging Asia, um, where I mean, of course, the developed world is not growing as much as what we're likely to grow. Now coming to how kind of shifting gears, at least near term, how things are looking. If you look at the current earning season, which is what is going to drive the market in the near term, overall basis, while earnings continue to show or deliver healthy growth rate, but if you look at the momentum is definitely kind of is slower than what it has been maybe in the past 4 quarters. So within that, if we look at expectations on the key sectors, yes, auto is likely to grow quite healthily, primarily because of the mix change as well as raw material decline is what is going to support that. They have seen a good amount of healthy price increase, which is what is further going to support their ability growth. Within BFSI, yes, the operating profit growth is going to be relatively moderate, but provisions or lower provisions are likely to support the overall profit growth. If you look at the near term numbers that were being kind of shared in their quarterly updates, pre-quarterly updates, it continues to show that growth on the loan as well as deposit side has been quite healthy of high teens or near 20% kind of a growth. Coming to capital goods, yes, this sector has been quite strong, especially given the order inflows that I've seen in the last 5, 6 quarters. So even the top line growth is likely to be quite healthy. And given that commodity prices have come down, we could see that margins are expanding, and thereby the profit growth is extremely heartening as such. If you look at cement and construction, we are going to see a 12 to 14% kind of one. The fact that there was mild monsoon, cement demand was quite healthy. We have seen that larger players have gained market share on the and especially given the current situation. And yes, overall prices were quite stable. With north or central region compensating for the weakness that was seen in south and east region. Technology, given the fact that we have seen global economy is relatively soft, and which is what is impacting the demand on the technology side. A couple of results or maybe three large companies have already declared their results, and which is what have seen a tepid volume growth, while the margins did show a bit of a resiliency given the attrition has been lower, but at the same time, demand is what is relatively lower as such and bit uncertain as well. If we look at specialty chemicals, of course, slowness in export volumes is what is impacting them. They actually had a very healthy margins in the last year, and which is why they have a higher base. While almost 4 quarters have passed on, maybe in a couple of quarters we could see a high base flattening out, which is what could help specialty chemicals going forward if the demand is likely to come back or the destocking, which is what destocking cycle, which is what impacted, would come back. Consumption and retail, yes, we have seen. Yeah, I am back. So on the consumption and retail side, of course, softening inflation has brought back some bit of demand, but coming festive season is likely to boost the sentiments. But yes, the lower monsoon as well as weak demand could affect the growth out there. Cable and wireless companies are seeing very strong growth. QSR companies may be seeing a bit of a weak SSG growth, and these are more seasonality factors like Adhik Mas or extended Shravan, which is what would have impacted the overall consumption demand. Now, while coming to the valuations, yes, India has outperformed meaningfully in the last 2 years if we compare it to the emerging markets. and S&P 500, which is the developed markets. On the on the left bottom, we are seeing that valuations have moderated as compared to the past. Even the earnings growth, healthy earnings growth that we have seen, while it continues on the top end as far as plus one standard deviation. But at the same time, at least the better earning growth visibility is what is driving the valuations. If you look at the BSE 500 median TTMP, while it kind of median, and if we compare the weighted average TTMP, so while the valuations out here, the green line shows a bit of comfort, but if you look at the median, possibly that is at one of the highest. So that shows that many of the companies are being traded at a very high valuations. So now, while we discussed about the near term, the medium term, which continues to be quite healthy, of course, there are some risks. And what are the kind of mitigation strategies that are there? We expect, of course, in the next 7 to 10 years, would see 10 to 14% kind of growth. If we look at the earnings growth as well as the overall economic growth, this would be supported by overall economic growth. But as far as this path is concerned to 50,000, what are the near-term risk or maybe medium-term to long-term risk is what we should discuss. Yes, crude, geopolitical situation, slowing global growth, as well as supply constraints impacting the inflation are the near-term risk. From a medium to long-term risk, yes, greed and complacency, because this is what drives the valuations to very absurd levels. One has to be aware about such situation. We're going to see elections in 2024. How they pan out is likely to be the determinant of our future for the upcoming decade, because we've seen in the past that at least the last two terms have helped Indian economy quite efficiently, and especially post COVID, we have been extremely anti-fragile. Tech development is, while it is a big opportunity, but at the same time, it could be a risk, which is where we need to be aware as well as need to take mitigation strategies needs to be in place. From a near-term perspective, of course, we need to put diversified portfolios in place. Don't be one must not be overly allocated to a particular asset class, particular type of asset class, where the valuations are at exorbitant levels. One needs to kind of keep emergency funds in place, as well as overall portfolio must be based on the risk tolerance as well as goal and the horizon that one is looking for. Fundamentally, as an investor, equity investor, we should ensure that stewardship activity or voting activity must go up in order to ensure that the companies are taking sound decisions as such. So even not just the institutional investors, which have to, from a regulation standpoint, have to vote for any kind of solutions that a company has to come out. Even large investors, large individual investors must start looking at voting on important decisions of the corporates. Same way, even the corporates, including the boards need to be kind of disciplined. They need to uphold the fiscal discipline and need not over leverage, take sound financial decisions, as well as ensure that they are able to have tech talent in place, which would help the company to steer this technological revolution that is taking place. And last but not the least, the regulator needs to kind of care of the market efficiency in place for us to healthily grow with the kind of compounding that is there. So again, the most important point for the upcoming elections for all of us is, while there is already an expectation that there would be a majority in place, but during elections there are always political compulsions and where there is a race to bottom. So we need to ensure that the party or the candidate that we are voting for is fiscally prudent and there are no burden on the government finance, because post COVID, rather the standing out feature of our country had been the fiscal prudence that we followed post COVID, right? So we, despite the near term challenges, we believe that India's growth story will continue to thrive. We are going to be the fastest economy in the world, and we need to make sure that we are putting in mitigation strategies to capture the kind of growth that is likely to come. I guess India's moment or decade or even the century is there in place. All of us have seen these commentary by global leaders. India's Amrit Kal, which is the next 25 years, are going to be the important growth factor. These are supported by Young India. Median age is one of the youngest population over the globe. Digital India is further spurring the growth, and enterprising India, especially supported by initiatives like Make in India, manufacturing PLI schemes, or Startup India. Of course, India continues to be one of the most vibrant startup ecosystem globally. So, future mega trends are well in place, whether it be demography, urbanization, as far even on the climate change side, we are taking good efforts. Digitization and innovation continues to be in place. Globalization is further helping us, which is a China plus one or the development of IP as well as supply chain shifts that are taking place. And nonetheless, right from top to bottom, cities are getting wealthier day by day, right? So all these future mega trends continue to be in place. So as far as our themes are concerned, we believe that these six themes are likely to be major beneficiaries in the upcoming Amrit Kal. Consumption, of course, because of the rising per capita income or discretionary spends in place. Formalization continues to be another theme where most of the firms are getting compliant, as well as raising capital, as is what we are seeing. SMEs getting formalized, they are raising capital from small SME exchanges. Clean energy or renewable energy, I mean, every other day we keep on meeting companies which are working towards reducing the carbon footprint, rather it be solar guys or for that matter replacing the single-use plastic as such, or for that matter, anyone related to the electric vehicle ecosystem on the battery side, on the battery management side, or the software related to the battery management side. So all these drivers of these themes are well in place. Financialization, we can't really ignore this with rising GDP. You could see banks thriving on financial services companies thriving on that. Globalization, especially like things like China plus one or Europe plus one for that matter, where energy prices impacted the economy out there. And of course, with the rapid change in technology, we could see a lot of platform companies being beneficiaries, as well as while near-term global slowdown is impacting the technology companies, we may see IT services companies coming back, push an improvement in global economy. So these are multiple mega opportunities of value migration. We could see snowball effect kicking in, and the India stack. So all these factors are multi-decadal themes, and one may need not really miss out on these themes for the upcoming decade. So this is a slide which I always share with most of the investors. India was once 30% of GDP. Currently, we are just 3%. Can it really come back, or can the history repeat itself? Right. So that's the thought that I'll leave you with. Thank you so much. Just to summarize, yes, there are near-term headwinds. We could see second half moderating. Valuations continue to be at the top end. But does that mean there could be short-term corrections? Possible, but those corrections are an opportunity to build our long-term portfolio. But at the same time, stay diversified. Look at your goals. Look at your near-term requirements. Have exposure to investments that are suiting your risk profile. Stay healthy, stay invested. We are likely to thrive. We are likely to be the fastest growing economy. And Amrit Kal is there to build a fantastic wealth for us. Thank you so much.